So, um, liquidity and candles, right? So, on a simple note, each candle contains three basic, three basic um, move, which is accumulation, manipulation, and distribution, right? So, the term liquidity, liquidity. Where is liquidity resting? Because the market only operates on booking liquidity and filling up imbalance, right? So you have to spot the liquidity or you become the liquidity, right? Now, places you can find liquidity: previous week low or previous week high, previous day high, or previous day low, old slash old highs slash lows. That is, weekly highs, weekly lows, um, you know, these are basically the place you find liquidity. And then they have the internal range liquidities, you know, which are some, a PDRA can be liquidity, right? So, let me get to this. So, the idea on how to spot liquidity is you go down to your daily charts and you mark out your highs and lows, right? So this old high formed in 31st May, this one right here, 6th June, this one right here, August, right? So you do this with respect to what's the higher time frame saying. So now let me just do something right here. So here we can see this candle, the high of this candle and the low of this candle, right? Sorry, I want us to focus on this candle, right? The high and the low. This is a fair value gap right here, right? Now, a lot of you might see it like, okay, the market came, tested fair value gap, and boom. That's quite simple. That's it. That's true. But then there's a lot to it. Now, this is a range. Watch this low, right? This swing low led to this high. The low that from the high that from the low, right? So this is a swing low formed 22nd August. That's an old low, right? There's a bunch of liquidity lying there. Let's go to the lower time frame so you see. That's a sell side liquidity. See how the market took it up into the weekly fair value gap and we move off, right? So the idea is this: your candles are ranges and also liquidity. So in order to understand them very, very well, you have to take yourself away from the noise. What is the noise? The lower time frame. Now I had to come into this lower time frame for you to really understand that this guy is a liquidity near the fair value gap, right? So let's say we don't have this and we are somewhere in the 1 hour. How would you have analyzed this? You might end up saying, oh, a break of market structure, a break of market structure, it closed with a full body here. And those stuffs we you do, starting out. No, the idea is this: you never ever buy after a high is been taken out, and you never ever sell after a low is been taken out, right? So if you are searching for liquidities to attack, it's either you're attacking a previous day high or low, a previous week high or low, previous month high or low, old lows and old highs, or internal range liquidities like a fair value gap or even an order block. They are all liquidities based inside them, right? So let me go to this again. And this can give you a model, right? This is the way I find my ranges. Your candles are range. You know, you take one candle, and just like I said, there are mostly three moves inside the candle: accumulation, manipulation, and distribution. If you We're gonna get to that, right? But let me just explain. Let me explain this liquidity quick and fast, right? So you want to, that's how I identify my ranges, right? So now you can see that the previous week low was taken, and we're about to attack the previous week high, which is another old high. So that's it. If you search for these liquidities around this area I've told you, you'll be fine, right? So your candles are ranges, and ranges bear liquidity at the high and at the low. That's the basic idea, right? So let me show you something else. So if you're finding it difficult, then you should actually watch some ICT videos, right? So now let me see, for this right here, the high that got the low that from the high, as I said. So these two candles, we are on 4 hour candle, right? Let's go to the weekly and see where these guys are. Now, come to the weekly. Look at it. It was a previous week high, right? It's just that simple, folks. Look at it. It was a previous week high. It's just that simple. And guess what? We took it out. And this previous week also took out that low day and took out this high. When you zoom out, come to the higher time frame, you see it's just their highs and lows. This is the best way you can dissect fair value gaps to know fair value gaps that might really work. When you mark your fair value gap this way, it you go down to the lower time frame, see it's kind of swing low, and when it's been taken, the market closes back into the range. Then there's high probability and high chances of it playing out. Just look at this beauty. How did it just become a weekly high all of a sudden? I didn't even know it was a weekly high, and it's a swing high on the daily. So that's it, guy. Your candles are ranges, and ranges they carry on the liquidities you're looking for. So um, that's it. You know, that's what I'm saying. Took it out and close back into the range. Then you attack the opposite side liquidity. So how I basically trade them is when the market takes one side of the range, which is the low, I'm looking to attack the high of the range. We still get the stop loss placement and take profit how you should work on that. So this is it for market structure break and sorry, for liquidities and candles. So you have to make sure you're writing these things down so it's enable you to practice. You understand? So that's it. And the next we'll do talk about is the candles and how they form and how you can trade them. Right? So the candles are ranges, just like I said, right? And inside a candle, you want to anticipate three moves: accumulation, manipulation, and distribution, right? So this is the visual drawing of what a candle looks like. So they open, accumulation, manipulation, OTE, and they close. Sorry. So this is basically what a candle is made up of. So the candle opens, the open is fixed, right? It accumulates. Now, note this: most times the market spend time accumulating, right? This is stuff I actually learned from my very good friend. You understand? I didn't come up with all these concepts. I learned it from my very good friend, but I just can't keep it to myself alone, right? So this accumulation, manipulation, and distribution, right? Sometimes OTE. Now this is actually a classic buy day, sell day, sorry. A lot of people get sucked up around here, and that's where time comes in. So we're gonna talk about time, right? But now let's dissect on how candles work, right? So let's use a daily chart or a weekly chart, right? Now the power of trade, which is accumulation, manipulation, distribution, right? So let's take this week for instance. This was a bullish week, and this was the opening, right? So the aim is when we are bullish, we want to buy below the opening, and when we are bearish, we want to sell above the opening price, right? So in 1 week we have 5 days, right? So 1, 2, 3, 4, 5. That's studied the price action, but folks. So um, yep, there you go. So now looking at this from the side of the power of trade, we opened. You can see something like an accumulation, right? Here's a range of that accumulation. Here's the range this high was taken already. So we accumulated, manipulated. Tuesday low of the week template. The good thing ICT thoughts us the Tuesday low of the week or high of the week, Wednesday low of the week or high of the week. So you can see how we accumulated most of the time on Monday, right? And then we manipulated on Tuesday and then we distributed, right? We distributed for the rest of the week and we closed, right? So the idea here is this: when you are bullish for the week, you expect the low of the day, the low of the week to form around Tuesday or Wednesday. And when you're bullish for the week, you expect the low of the day, the low of the week to form around Tuesday or Wednesday most times. Sometimes it can actually form on Monday, but most of the times it's actually Tuesday and Wednesday. And the aim is to buy below the opening price of the weekly range, right? And to sell above the weekly price of the day of the weekly range. So there are a lot of ranges, right? You have the let me just make it simple. The Asian range and the Monday range, right? So these two range it's quite easy to trade with them, right? Let me find a Monday. Let me explain something about Mondays, right? So this is Monday. Uh, this is Monday. Yeah. So the Monday ranges, right? So the way you trade this is um, when you come, you take the high of Monday and you take the low of Monday, right? Now notice how we took out the high of Monday, created the high of the week, and then we attacked the Monday low, right? This is how you use the basic Monday ranges, right? Sometimes it works, sometimes it doesn't. It's your aim as a trader to keep your risk short, right? So the high of Monday, the low of Monday, and the high of Monday was taken. That's forming, a high of the week, and boom, right? So it's safe to say that when we take out the high of Monday, we are looking to attack the low of Monday in a bearish week. That can be your model, right? So if you're not writing this things down, then you have to watch this video multiple times, right? So basically, it's just that, and same goes to the Asian range. When you take out your Asian range boxes, which is something like this, right? Uh-huh. The Asian range, just the Asian box. Mostly the Asian range is for accumulation, right? So when we take it out, something like the Shanghai or the low, you 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 see it more like a judo swing, a manipulation after an accumulation, and then the distribution to the downside if it was the high we took out, right? So that's it, folks. The highs and lows, the candles are formed in a you know accumulation, manipulation, and distribution phase, right? Let's look at this last candle before I wrap it up. All right. Yeah. So let's let's zoom out. So this was the range, this high and this low, right? I wanted to notice how this low created this high, and this high was the high that took out this high, right? And then this low was the low that created this high. Let's look at the higher time frame and see if this is a candle. What is this, man? Let me remove it so you don't get confused. This is your fair value gap, right? I don't I don't disagree with that. But this is your fair value gap, right? Now when you take the low of this, or rather the high of that fair value gap, which is the low of this candle, and the high of this candle, right? Notice how market was accumulating inside here, and then the moment it took out the high, we came for the low, right? So this is the stuff I want you guys to know about, right? This is where your market structure works most times. Now this a market structure break, took out the high and then came back here. Yeah. Why is the market structure break? Old low was taken, came back into the range. That's a key level, right? And some of you might use this as another block, right? But most times I actually use this, and then I use these swings to find a meaningful stop loss of where price shouldn't go to, and why you shouldn't go there, right? So this candle, on the novice side, all you're seeing is just a fair value gap, right? But then when you scale down into the 1 hour, this is it. Then it takes out liquidity, and this is the fair value gap I do use myself. And that's how I get my snipers most of the times, Inside your PDRA, there's another specific PDRA that price might hit due to and due to a resting liquidity above or below it. Right? So market took out the liquidity, NFP, and boom, right? So you could see that accumulation. It's all in one candle, right? All in one candle. This is one daily candle. Accumulation, manipulation to the downside, and distribution to the upside. So yeah, most of it come in form of this. That's just it. So the best class should be more of the AMD and the entry techniques, right?